Hi, I'm David Harrell, editor of Morningstar's Dividend Investor newsletter, and I'm joined once again by Dave Sequeira, who is Morningstar's chief U.S. market strategist. Dave, thanks for being here.
Of course. Good to see you, David.
Okay, so we spoke back in January, and we discussed U.S. equity market performance in 2023, and you also shared your 10 dividend picks for 2024. So I wanted to revisit those picks as well as any new ones you might have. But before we do that, can we talk about market performance in 2024, both the overall market and dividend payers specifically?
Of course. So dividend stocks have actually had a pretty good year thus far this year. Year to date, the Morningstar US Dividend Composite Index is up a little bit over 9%. So pretty good year for only being halfway through the year. Now, of course, that still trails the broad market average, which is up, I think, almost 14% year to date. Now, of course, the differential between that is AI stocks. I mean, really the focus thus far this year has been in anything artificial intelligence. Those stocks have continued to surge, and pull the broad market up, much further than, the dividend paying stocks. Now, having said that, we do think that the market is starting to get slightly overvalued here. It trades at about a 3 to 4% premium over a composite of the fair values of the stocks that we cover. But when you break them down, you do still see some opportunities in today's marketplace. Now, core stocks and growth stocks are overvalued, trading at about 6 and 7% premiums respectively. And of course, that's where you're going to find all of those AI stocks.
Right.
Whereas value stocks have definitely lagged the broad market. So value stocks are still trading at about a 9% discount to a composite of our fair values. So we see a lot of opportunities in the value space, which is of course where we also see a lot of those dividend paying stocks. It's interesting too, right now I think about 2/3 of the market performance this year is really based in only 10 stocks. And in fact, if you look at NVIDIA just in and of itself accounts for, I think, about 25% of the market return thus far this year. Yeah.
Can we run down your dividend picks from January and get your current take on each of them, and maybe start with Gilead, because I know that's probably the worst performer so far in 2024.
Yeah, it's been a disappointing year thus far for Gilead. Now, the performance of the company has actually been in line with our own expectations from our equity research team, but it does appear that the market has been disappointed by relatively modest growth, at the company. So we have seen the stock sell off. Now, having said that, from a dividend point of view, we're still comfortable that the company will be able to maintain its dividend. I think its dividend payout ratio is only about 50%. But with the market action, I think it's going to be one of those stocks that maybe is going to be more volatile than what we initially had thought, going forward. At this point, it might be a little bit more appropriate more for value investors who are looking for those stocks trading at pretty deep discounts to fair value, as opposed to dividend investors who are really looking just for that dividend income. So again, I do think the dividend income there, you're going to be fine. We're not expecting any kind of cuts in that dividend, but I do think it's going to be a more volatile situation going forward than what we originally expected.
Okay, so this might be one that you swap out for a new pick.
It could be, depending on your tax situation, yes.
And what else has disappointed so far in 2024?
Well, I've been disappointed in the price action at Kraft Heinz stock. That one has sold off a bit thus far this year as well. Now, this is one that really shows, our view and our differential in our view versus the market. So we actually upgraded our economic moat rating on Kraft Heinz this year to narrow from none. And of course, that means that we expect the company will be able to generate excess returns on invested capital for at least the next 10 years. And a large reason of that is because the company's really changed their strategy over the past 5 years, really going back to focusing on building long-term economic value as opposed to their prior strategy where they were prioritizing short-term profits. So at this point, it's a 5-star rated stock, trades at about a 40% discount, from our fair value, and pays a pretty healthy dividend yield of about 5%.
I believe real estate is currently the most undervalued sector, and you had a couple picks from the sector back in January. How have those fared in 2024?
They've been under pressure thus far this year. Now, real estate in and of itself is still the most hated asset class, on Wall Street. So we've seen that sector actually sell off this year. It's the only sector that has a negative return, year to date. Now, when I take a look at these two individual stocks, we're still pretty comfortable with the fundamentals on both of them. So the first is Realty Income Trust. It is a stock that we think has, pretty good defensive characteristics. It's a triple net lease provider, which means that it can actually flow through to its tenants, its own inflationary cost increases. So even if inflation were to make a comeback later this year or into next year, I think that one's got some good cushion there, as well. But it's a 5-star rated stock, trades at about a 30% discount, from fair value, and pays a nice healthy 6%, dividend yield. So this is the one that's going to be the most correlated of our real estate coverage with interest rates. So our U.S. economics team does expect interest rates to continue to keep coming down. They've been coming down here in the short term, but second half of the year and going into next year, they're looking for lower 10-year yields. So that should be a good tailwind for all of real estate, but specifically this stock. The other one is Healthpeak. Now, again, another stock that we consider to have good defensive characteristics. They are a real estate investment trust that mostly is invested in medical offices and research facilities. Again, fundamentally, we think this company is doing, just fine. So even with the stock being a little bit under pressure from, the higher interest rates now as compared to the beginning of the year, we're not concerned from a fundamental point of view. Again, another 5-star rated stock. Trades at a very deep discount from intrinsic value. I believe this one also has about a 6% dividend yield.
Great, great. Now, last year we saw some of the bank stocks sell off following the bankruptcy of Silicon Valley Bank. And you had a couple picks from the sector. How have those fared in 2024?
So it's going to depend on the individual banks. So with US Bank, that was our pick last year. We've seen, some increases in, loan loss reserves, some increases in defaults. And I think the market is a little bit skittish as far as, how much those might increase. I know our economics team is looking for, increase in, default rates and for loan loss reserves, but really only going back more towards, historically normalized levels. We're not looking for them to surge higher, which is what I think the market is concerned about right now. So US Bank still looks attractive to us. It's got a wide economic moat. I think it's the only regional bank that we assign a wide moat to. Stock is a 4-star rated stock, trades at about a 20% discount to fair value, and has a 5% dividend yield. The other one is Truist. Again, that's going to be a pretty similar story. Just looking at, their funding costs, still being relatively elevated here in the short term. We, along with a lot of other people, actually expected the Fed, to start cutting interest rates by now. Our base case right now is we're looking for the Fed to start cutting here in September. Once that starts to happen and it brings down some of their short-term funding costs, I think that'll give a good tailwind, to that stock. It's currently trading at a 4-star level as well, also a 20% discount to fair value, and has about a 5.5% dividend yield.
Now, utilities, obviously fertile ground for dividend investors. And you've been bullish on the sector since late last year, I believe. How have your picks there fared?
Pretty well. Now, interestingly, WEC has not performed nearly as well as I would have thought it would have performed. I think this is going to be an interesting opportunity for dividend investors to take a look at. So WEC, the old Wisconsin Electric, actually is probably one of the better plays as far as looking at the increase in electric demand for artificial intelligence. AI computing, of course, takes multiple times more electricity than traditional computing. And what we see is there's a number of different data centers that are currently in construction in Wisconsin right now. So we do think that that's going to help give that company a good tailwind for growth over the next couple of years. So that's one I would take a look at if you're looking to play kind of that increase in demand for electricity. It's currently a 4-star rated stock, trades at a 17% discount to fair value, has a 4.25% dividend yield. And then the other utility stock, which I think is also one of our picks on our equity research team, is Entergy. That's one where we just think it has, the best combination of, potential growth characteristics, good management, strong regulatory regime. It's also a 4-star rated stock at a 15% discount, pays about a 4.2% dividend yield today.
Great. And I think on WEC, Microsoft recently announced a new project there as well in Wisconsin. So
yeah, well, those northern states definitely have an advantage as far as being able to build those at data centers, because of course one of the biggest costs for data centers is keeping it cool. So in those northern states, especially in the winter time, it's a lot more effective to keep them cool than in some of the southern states.
Let's switch over to communications. I know you've recommended Verizon for a while. How has Verizon been performing in 2024?
It's been performing pretty much in line with our expectations. And that's really one that had been both a pick from a valuation perspective as well as a dividend perspective. It's still a 4-star rated stock, trades at a 24% discount to fair value, and about a 6% dividend yield. So quite attractive. Really, I think what the biggest kind of difference in our opinion versus the market on that one is that we do that expect over time that the wireless segment will start to act more and more like an oligopoly, meaning that they'll compete less on price. So that's going to allow their margins to increase over time. And looking at the results over the past couple of quarters, I think we're starting to see that.
Okay. And if we switch over to energy, I know there was some news for Equitrans, which was one of your picks back in January.
Yeah, this actually turned out really well for investors on this one. Essentially, it is getting bought out. So we saw that stock, really just, surge right up towards like our fair value estimate on that one. I think it's up well over 30% from when we first, started recommending it. So at this point, it's probably not a good time, to actually move out of that stock. I think the value has been captured there and probably look for, other dividend opportunities to be able to reinvest into.
Okay, great. And I know you have several new picks for the second half of 2024. Could you share those and maybe give your rationale for them?
Of course. So the first one is energy transfer, and really this is really a swap idea for Equitrans. Now, Energy Transfer is a four-star rated stock, trades at a 24% discount and a 6% dividend yield. It is also a pipeline company with storage facilities as well for LNG, natural gas, and oil. So I do like this one as fitting into that energy section within your portfolio.
And I believe your other two picks are names that investors are definitely going to be familiar with.
hmm Yeah, so the first one is Clorox. Now, this is a really good example, I think, of how the market over time often acts like a pendulum and can swing, too far in one direction or the other. So, of course, with Clorox, early during the pandemic,
Right.
Clorox wipes were like gold. That stock surged, and in fact, it didn't just surge; it ran up so much that it actually got all the way up into one-star territory. At that point in time. Now, of course, they've also had a difficult time, I think, beginning in 2022 being able to put through kind of their own inflationary cost increases, through to their customer base. So we started to see margins, getting squeezed. And of course, sales also were slowing down at that same point in time. So that stock had been then on a multi-year decline. And it looks like it bottomed out maybe fall of last year. Looking forward, when I look at our model, we're really only looking for relatively modest growth on the top line. We are looking for them to be able to continue keep putting through some of those cost increases over the next couple of years, get back towards more of those historical normalized operating margin type levels. So I think this is a good one for dividend investors, especially patient investors, to take a look at. It's a four-star rated stock, trades at a 20% discount to fair value, has a 3.5% dividend yield. And then the other one in the healthcare sector is Johnson Johnson. Now, I always look at Johnson Johnson as being a core holding, type of stock, wide economic moat, low uncertainty rating. I think everyone's pretty familiar with Johnson Johnson. The story here is that they do have some competition coming this summer in the biosimilar market for one of their patented drugs, which is, going to be losing its patent. But when we look at, the research and development pipeline and we look at new products and when we think they're scheduled, to start coming out, we think that they're going to have, enough top line growth to be able to make up for that additional competition. So again, it's a stock, not a huge discount, from fair value, but this is one where it's pretty rare to find it trading at much of a discount. I think it's about a 10% discount, just enough to put it in four-star territory today.
That's great, Dave. Thank you for sharing your insight. It's always good to have you here.
Of course. Thank you, David.
I'm David Harrell from Morningstar. Thanks for watching.